Well, our next guest that rhymes with Oni Wire says Powell got it wrong today. Let's bring him in. Tony Dwyer of Canaccord Genuity.
We're now CGF.
So how did he get it wrong?
When I say they get it wrong, I don't take an academic view of something I learned in school. I look at what the credit markets acted like, and the euro-dollar, all the various credit markets said, wow, that they could have been a lot more dovish. My opinion is totally irrelevant. It's what Grasso said. It's the market's opinion, and all the various credit metrics worsened as the press conference went on. So this is the whole reason we were on last week, and we highlighted the two indicators you got to wait for to show you that the momentum of the market is actually bottomed, because we're just in a violent market. And when you're in a violent market, you can't make today, you want truth be told, I'm surprised it wasn't worse. I think today is an example of how oversold the market is, because the way the credit markets acted, I thought the stock market would have been down a heck of a lot more, and it actually didn't accelerate to the downside in the last half hour. It actually stabilized. So maybe tomorrow it gets worse. I'm not sure. The one thing I know is, going back to Tony Iyer or whatever the heck we said earlier, the yield curve is still positive, which means credit is it's kind of frozen up right now with the stock market and the way it's acting in the Fed meeting. But ultimately, once the stock market stabilizes, it should reopen. And I think it's really interesting. All you got to do is look back to 2016, Mel. The bank stocks were down exactly to the percentage on the BKX that were down today from peak.
Right.
If you look at the Russell 2000, same. Amazon, same. IBM, same. Citigroup, same. They're all. So this isn't unique. We want to make it unique, but it's not unique. And I was equally as wrong then, and people forgot that because we stayed bullish.
What's your price target for the year, and are you going to change it? I mean, we were just talking with Jonathan Golub the other day at Credit Suisse, and he cut his price target because of the volatility we've seen in the past few weeks.
In October, what we did when you got that whoosh, we called it the shock drop, and then we went into the slot pop and drop retest thesis. Yeah. We're in the bottoming thesis. We still haven't come out of that, obviously. So we pushed out our target into next year. We're still at 3,200. I don't see any reason. My earnings estimate hasn't changed since the summertime. I see how people are moving around. I only expected 5% earnings growth next year on 162 in earnings this year. So where I got the multiple wrong was I thought everybody else figured the same thing. And because it was so apparent that you were getting this boost from the tax cuts. So to me, you're pushing out the upside until after you invert that yield curve. I have two sources that I use to tell me when credit's frozen. One of them is a bank CEO. I call it the fireside chats. I called him last week, and I asked him, is your lending standards changing? He said, no, we can't lend enough. The issue in the marketplace is that shadow banking has taken over so much of the lending from traditional banking.
Right.
There's so much money around being lent in shadow banking, they can't lend enough. That's not what happens when you freeze up an economy.
So, Tony, let's talk about the yield curve, because you said it inverts and everything's fine, right? That has worked almost every time in the last 40 years, except for twice, which was in the 1980s, where the recession actually happened when the yield curve was inverted, not when it was re-steepening. That's the same time that we had a strong dollar, we had a tax cuts, we had a strong economy. So is it different this time?
It was the 210 didn't invert prior to the yield. It did invert prior to the recession. I think it was 8 months in 1973. That was the closest one. I think in the 80s it was 11 months. I got to check my numbers, but you have not inverted the yield curve after a recession has begun since the early 1950s. Now you could pick a different yield curve to make that work. I'm using the 210, and before the two started trading in the 1970s, so I used the 6 month prior to that. Again, maybe it's different this time with quantitative easing and the whole 9 yards. For 2 times this cycle, in 2011 and 12, we were in a global recession on the European debt crisis. In 2015-16, the exact same amount we're down now, we were going to be in a global recession because of the commodity crisis. In both of those periods, your markets were worse than they are now, credit spreads were worse than they are now, and it wasn't. What's different this time is the Fed has raised rates significantly. That is meaningful. We are trending toward the end. As I've always said, this is going to end badly. Can't fix debt with excessive more debt.
Right. Tony, thank you. Good to see you.
Thank you,
Tony
Mel.
Dwyer of Canaccord Genuity.